what's the single biggest shift carriers and brokers are optimizing for right now, and what kind of led to that movement?
So, if you're familiar with insurance, the value chain or where you have most value is claims. How are you going to pay the losses, fulfill the promise of, like just being there when you need it the most? There's underwriting, which is can you actually price the risk correctly? Uh, when I started my career in insurance, one of my managers told me there's no such thing as a bad risk as long as you price it adequately. So that price precision is super, super important. But what we're seeing now with insurance is not about the process of the workflow, it is about the promise of AI. So the question you asked me before, when I got hired at Databricks, we were going and telling insurance companies that we were the data and AI and the data and AI company. And everybody was just going like, I don't believe in AI. That thing doesn't exist. I don't even want to talk about it. And most of the practitioners of Databricks were your data engineer, your data scientist, maybe your enterprise architect, but it was not the business. What's changing right now is we are talking to CEOs, and the number one thing that we hear is I would like to have at least one AI use case into production by the end of the year. I was blown away that not only in insurance, but CEOs have this excitement around AI. But of course, as you can imagine, they want to see the return on investment. So from a Databricks perspective, we normally look at value from infrastructure, productivity, and now we're looking at business outcomes. So that third piece on the business outcomes, that's where what has changed. That connection between the technical and then the business, and of course quantifying the return on investment.
Everyone wants speed, but centralization can slow it down. What's the real promise of data mesh slash domain ownership in insurance, and what gets faster and what doesn't?
Data mesh is a term that can mean different things to different people. So let's just take a step back and define it, right? Is getting the data products in the hands of the people that understand the business. Doesn't mean decentralization, doesn't mean just like everybody doing their own thing. I think like that's the biggest misconception that people may have around data mesh. Now, if you think about it, it's not just that all of a sudden things are going to get faster, right? So let's think about what exactly is going to get faster. Well, it's not that you get rid of the governance, it's less handoffs. So as an example, if you're familiar with underwriting and insurance, somebody issues a quote. Let's say you are insuring a taqueria in New York City. Um, the ability for you to price the risk, get the quote, understand what type of restaurant you are launching, where are the locations, what is the industry. It is a very manual process. So let me just define how insurance is very different from lines of business. So of course, if you are getting an auto insurance, you can do it in the app. Everybody has an app. That's like 10 years ago. But it is those risks that are very, very hard to price. Um, think about terrorism risk, right? Like nobody thought that you can price terrorism risk. Now, a question that I get asked nowadays is, can you actually insure AI? I think it is a big question, right? But eventually, just like like catastrophe events, nobody thought that you could insure that, but like you have to come up with an estimate on events that are very unlikely to happen, like 1 in 10 years, maybe 1 in 5 years. But like you also have to predict how big would the catastrophe be. So the challenge with data mesh is that you need to have the right governance, and you need to emphasize lineage. So let me just, for some of the non-technical audience, let me just define what lineage is. Lineage is understanding who created the data, who has access to the data, who modified the data, and the upstream and downstream dependencies. As like you're very familiar with Databricks, Databricks can do lineage very well. So now all of a sudden you are fulfilling the promise of data mesh, which is your data products, your data domains, with a good interaction on the business and the people are actually creating those data products.
What's stopping insurers from delivering on this promise of data mesh?
Regulatory bodies. I am an actuary by background, and I can tell you that most of the time you are putting a lot of your profession on the line when you're signing up for coming up with something as precise as the premium that you need to be paying for the risk. So uh, let's talk about like what are the different regulatory bodies, and this is something that everybody's talking about. So specifically for insurance, there is the NAIC, which is the National Association of Insurance Commissioners. Their job is to come up with like regulation for insurance. And just recently, we've been working together on AI model law. Uh, Go back to the financial crisis. So now insurance companies are following suit, and that would be something that's actually needed. So it's not that they are against the concept of data mesh, and like if anything, like that actually can help a lot of insurance companies uh, do adopt and embrace everything that's happening from a technology perspective, while at the same time having the right guardrails. So again, it's not that everybody's like doing their own thing. It's just like you're changing the way you're thinking of just the central team doing things. They're no longer doing that, right? Because like they are relying on the data products and the data domains and the people that know the business, but they're the ones that are enforcing the guardrails to do it in a responsible way.
If domains own their stuff, how do you prevent fragmentation and still maintain enterprise control?
That is the biggest fear that people have with data mesh is data silos. So let's take it back to insurance. So you have your claims team and your underwriting team and your actuarial team, and they are all interested in coming up with what is the total premium, right? Like again, like the money that you collect from insuring different customers. Well, again, premium can mean different things to different people. And the best way to implement and solve for those data silos is having this federated governance. And again, what that means is like those data teams are not doing the actual work and the data consumer and the data producers, but there are the ones that are enforcing the guardrails. That is that takes a lot of change in the way that you're structured, but it's mainly like also like changing culture, changing responsibilities, and having like the right skill set and communication across different teams.
Real time risk pricing sounds very powerful, but also a little bit dangerous. So, what does real time mean in practice? Are we talking about minutes, hours, days? And what's the business reason, the business case for doing this faster?
Okay, so great question, by the way. Let's take a step back. There's no such thing as real time pricing. And let me explain to you why. Um, just the process that I just outlined with regulators, right? Like it takes time for you. Like let's say you come up with the right price that is instantaneous. You need to get it approved. You need to get it approved not only with like this specific regulatory body in your state, so it's called like Department of Insurance. That's not going to happen real time, right? So like you change the price as frequently as the risk changes. It can be maybe every month, it can be maybe every quarter. However, Let's take the example of telematics, right? Everybody's familiar with telematics. You want to have the right driving behavior. How are you harsh accelerating? How are you braking? How are you speeding? That's not necessarily new, but what you can do now with telematics and the behavioral information that you are collecting is you can go from like loss mitigation, which is just paying the loss, to loss prevention. So what do I mean by that? You are driving in New York City, and all of a sudden there is a storm. We just got one of the biggest storms in New York City. Schools were closed. It was a disaster. Well, in that case, your algorithm has to incorporate not only your driving patterns and how you're like accelerating and braking, but also weather conditions and road conditions. So now you can give signals that are real time on this is not the fastest route, but now this is the safest route. So it is an optimization problem where you're bringing multiple different sources of data that have, like different frequencies, different levels of granularity. Again, some of them may be the structure, which is like, what's your age, what's your gender, where do you live? But a lot of it is unstructured or semi-structured, which is, telematics is JSON files or semi-structured data. Now, if you take it one step further, we're hitting a lot of unstructured data in insurance from the sense of like video, images, text, and auto. So now people are looking at like, if I were to get into a car accident and I upload a picture of the accident, how can you correlate what you can see from the picture to like, let's say, a witness report? So the possibilities are endless, and it's a very exciting time where you can finally grab those data and like turn it into insights.
Marcela, can you define omnichannel underwriting in a way that actually matters to executives, and what changes operationally when omnichannel underwriting is, you know, real versus just something that's nice?
Underwriting specifically is when you're unifying the appetite rules. So that means like, do you want to write this risk? Yes or no? Again, we talk about terrorism insurance. You talk about like insuring AI. You talk about insuring catastrophe. But you need to marry that underwriting appetite, coverage eligibility, which is just like, like is this risk even covered, right? From a policy terms and condition, is it excluded? Do you have the right coverage, deductible limits? And once you pass all of those rules, is then what should be the right price and how is that going to be competitive? Now, omnichannel means that you would be able to have the same integration between those business rules from a process, as well as the rigor of coming up with the right price. It can be just, like strictly just machine learning. It can be regression. It doesn't really matter. But we're living in a world where the expectations from different generations are different. So, for example, for me, I get quotes from insurance for homeowners in mail. I hate those. I take those, I take those offers. I just like shred it as soon as I can. I want to be able to shop for my insurance digitally. However, when I do get into an accident, I don't want to be talking to a chatbot. I want to be talking to a person. I want to be talking to a human. So omnichannel insurance, and especially in underwriting, means that you do have that connection between the price and the rules, regardless of where the quote was originated. So right now, there's a lot of operational systems. For those of you that may know insurance, you know that there's Guidewire, there's the Creek, there's Majesco. But an operational system that just means like, where is the data originating, right? So think about where you get your premium, where you get your information about the risk that you're insuring, and those are very, very outdated. Something that really excites me of what we're doing at Databricks is around the concept of interoperability. What do I mean by that? People want to marry that operational system transactional data with the analytical data, which is just basically your data platform. So we are building connectors where you can extract the data of your operational system, put it into your data, like your data platform, whatever of your choice, hopefully Databricks. And then you are having a real feedback loop where once you run like whatever models, you put it back into the system so that if you're an underwriter and you wake up and you're trying to prioritize your quotes, you don't log into Databricks. You're actually logging into whatever operational system of your choice may be. But behind the scenes, you're benefiting from the compute of Databricks. Uh, that to me is super exciting. And that's what changes from like keeping the subject matter expertise in your people, whether you're claims person, your underwriting person, your business persona, while they're still embracing some of the technology that's happening a little bit under the hood.
If you could put 3 signals on one weekly executive page to prove underwriting is improving, what are they?
Number one, straight to processing. All that means is how much you're automating the process. Again, like if you're insuring something that is vanilla risk, low coverage, low premium, very, very stable, you shouldn't have a human touch in this. We hear it all the time. Like, I do not want my underwriters spending time touching policies that, like the underwriting precision, the price precision doesn't really matter. So straight to processes is how can you automate a lot of the simple quotes, and how can you direct the more complex risk, again, like the taqueria, avocados, business that you have across like different places, and then ask the right questions. Because if you think about the time that it takes to like rekey a lot of the information, you come up with the quote, then maybe you need to do an inspection. Maybe you need to send somebody to just look at the conditions of the restaurant, whatever it may be. And like that process can be very, very time consuming depending on how complex can the risk be. So straight to processing is just your efficiency metric. The second metric is profitability. You probably know that at Databricks we come up with these like outcome maps, which is how are we aligning the strategic priorities to like use cases and then bring the technology. So of course, not only for insurance, but I would say for all, like banks and the rest of financial services, you wanna grow, but you wanna grow in the right places. So profitability in insurance is measured by loss ratio. So that's the second one. And then the third one is the expense component. So think about the discussion we're having at omnichannel. The customer acquisition cost for your web portal, like somebody that just like, think about your lemonades, think about like everybody that just have like this like digital portal that, by the way, has been around for decades. The cost of acquisition is a lot lower than if you're actually meaning customers, like the higher risk, like like the customer satisfaction, just like higher risk, higher reward. Those customers, the acquisition cost may be obviously a lot higher. So when you look at your loss ratio and your expense ratio, your overall measure of just like how you're running your business is your combined ratio. So loss, expenses, straight to processing.
Awesome. Well, thank you so very much for your time, Marcela.
Thank
Those
you.
great answers.
Thank you.